shared over on the cloud as well. So here we go. Hello, everyone. This is Mike Koenigs. I'm here today with someone I absolutely love, Mr. Phil Town. He is New York Times #1 best-selling author twice over, and we are here to talk about investing and the market crash and whether or not this is a recession we're looking at, a depression, or where are you going to put your money safely? Where are you going to invest? How are you going to invest? How to think in these crazy times. Phil Town, hi there.
Mike, it's great to see you again.
Yeah, my friend.
Always good. I remember when I came to your studio in San Diego. Are you there in that studio now?
I am. You know what I did? So that was right about 2 years ago, I believe. I decided to liquidate everything, simplify, and move towards a life of pure virtualization and elegance so I could have a much more personalized experience with folks. And I sold and liquidated everything, and I built a brand new studio, multi-camera studio in my house. Oh. So the good news is I felt this coming, even though God knows how it happened. But that huge studio was like, you know, it had to be run by a bunch of people. And we had 7. Well, actually, that was the second to the last studio. But anyway, I'm not in there anymore, thank God.
It's better. It's better at home.
It is. I love it. Absolutely love it.
Yeah. It's definitely better at home. I love being at home. I've been working, you know, I've been just about forever. And we had a horse farm north of Atlanta. So our offices were up there. And then we moved to this one when we bought this during the last recession, which was, man, the real estate deal was amazing that we got on this place because this farm, I mean, you can imagine what horse farms were going for when nobody had any money to buy real estate and you couldn't get a loan, right? So this guy's business started coming apart and he had to get out of it. They did a short sale on it and then they foreclosed on that because they couldn't get a short sale sold. And we ended up picking this place up for just like, basically Regions Bank had it and a bunch of lawyers were determining how much to sell it for. And we made them an offer. And long story short, we made repeated offers at the same basic price for 2 years. And then the bonds in Greece went to pieces and all these financial institutions, stock dropped like a brick and they started seeing, oh no, here we go again. And they just liquidated and they just turned it over to us. So it was a rule.
Lucky you, lucky you.
Right there, man. That was, patience is the key. We're going to talk about patience today. I imagine as we get into this. Patience it's a great business attribute is to be patient.
So much so. So for folks that don't know your background, can you give us like the little 1 minute mini commercial that gets people riled up and says, okay, I want that guy to be my best friend. I want him in my life.
I don't know if that's going to happen, Mike. I'm sorry, but I can give you the thumbnail. I'm right now I currently have a fund that I run that's just pushing upwards to what, 80 million or something like that, and then a hedge fund on top of that, and then we have an investment education company that teaches people how to invest. That is really our pride and joy. We love doing that. The whole family's involved in doing that. Melissa, my wife, her sister, my brother, everybody, right? So we love teaching people to invest and we do that. And that all happened completely. I mean, it was just so weird. I was a river guide in the Grand Canyon and damn near drowned a really good investor. And the guy like sort of laughingly said, well, you saved my life. And I went, yeah, right. And I ended up being offered an apprenticeship with him to learn to be an investor. And I'd been a guide. I'd been a soldier for 4 years and I was a guide for 10 years. So I'd been living out of a sleeping bag for maybe 13, 14 years. And basically was homeless, but didn't know it. You know, I mean, now totally homeless. I'm oppressed. But at the time I thought I was just living in my Volkswagen van because it was convenient and cheap. And would hang out at the offices up there where we ran river trips out of Arizona. And from that moment of that guy saying, come on and learn, I started down this road that we call Rule 1 investing, which is based on what Warren Buffett does and very long-term investing. with the use of options to accelerate the rate of return and to generate lower risk. And so we've been doing that for a long time. I wrote 3 New York Times bestsellers about that, and that resulted in this whole education business starting up. So here we are. We love to promote it, and we love to help people understand that there's choices out there, and how those kind of choices would relate to starting your own business, how you would structure a business that a good investor would want to buy, somebody like a Buffett, that kind of thing is what we do. We love it.
Yeah. And I'll tell you, so in the time that we've known each other, which is gotta be, I'm going to guess around 7-ish years or so when I met you first. I've just loved studying what you do, how you do it, and how you think, more importantly, which I think is the big takeaway from my lens of what people need to, like right now, like everything changed overnight, and you can decide the meaning you give it, how you think about this, and how you're going to play your money, how you're going to keep your cool. And my suspicion is you're probably going to say what I believe as well, which is these are the times when fortunes are made, when people are scared and they're withdrawing, and there's more opportunity now than ever before. But I'm not going to put words in your mouth. I'm curious, if we get this show on the road, what should folks do? How should they think? And what are your predictions for the future?
So first off, we're not very good at making future predictions, other than particularly with companies we understand. We can feel pretty competent in terms of looking out into the future on those companies and saying, okay, I mean, here's how great my crystal ball is. Yes, this company, Chipotle Mexican Grill, will be bigger in 10 years. Yes, I feel pretty good about that. Pretty solid prediction, because they're doubling the number of restaurants they're going to have. There's plenty of room for them to do it. So those kinds of things, I think I can understand a burrito company pretty good. The market, honestly, I have no idea, other than understanding history about the stock market, is that, and this comes from the guy who started this kind of investing, who taught Warren Buffett. His name is Ben Graham, and one of his great insights was that the market always is, in the long run, is always weighing every company in the market pretty accurately. It's going to give it the correct weight in the long run. Okay, in the long run, it's 5 to 10 years. In the short run, the market is a massive voting machine. It's all about emotion and what's everybody into, or what's everybody scared about. And therefore, in the short run, you may find bargains that shouldn't exist, right? I mean, people should be rational. They should never sell something for $100 it's worth $200, but they do it all the time for really very good short-term reasons. If you're a fund manager, you don't want to be outperformed by the rest of your peer group, so you're going to have to get out of a company like a Chipotle Mexican Grill that's got somebody puking in their restaurant because of E. coli. What's going to happen from being a fund manager forever, and you're a smart person from Harvard. You got to sell that company and get the hell out of the way, because everybody in your industry is going to sell it, because they don't know how long it's going to take to fix this problem. Now, they also know it will get fixed, but that would require you to have a very long-term view. You're going to have to look over this deep valley created by this problem and see that, in the future, 3, 4, 5 years out, yeah, Chipotle is going to be fine. But that's too long for us, because we get judged on a quarterly basis, not 3 years, 5 years. I said, I would love it if I could get judged that way, but nobody's going to judge me that way. The pension guys that are putting money with me all want to know how I'm doing this quarter compared to the other guys. If I'm doing well, they're going to take their 50 million. They're going to go down the street. I know I got to keep up with everybody. I can't look long-term. And therefore, we have this massive advantage as small investors to just simply be patient, pick a few companies we like, and get into them. And a time like this, so we don't know what the market's going to do. We just know that it can misprice things dramatically when there's a lot of fear or a lot of greed. And there's been a lot of greed, right? We've had 0 interest rates. Everybody's like, oh, the market's going to keep going up. And now we have a lot of fear. And that fear lasted about 10 minutes. The market dropped like a brick. And then the Federal Reserve jumped in. And every fund manager out there has learned, don't fight the Fed. The Fed's coming in, back in the market. And boom, the thing went right back up. So I'm going to get out my crystal ball for you, okay?
Yeah, let's do it. This is the time And I also want to just acknowledge all the folks that are here right now: Victor, Victoria, Vibu, Timothy, Tara, Tammy, Sherry, Roette, Rachel, Patrick, Mike, Mark, Malcolm, Kirana, Carrie, Kelly. I mean, we got a huge audience here. And what I would suspect they want to know is exactly what you're going to do, which is what's the crystal ball. And also, once we get into this, we'll talk a little bit about the fact that you've got training programs as well as a fund. And so there's multiple ways. So it's sort of like a do it with Phil.
Hold on 1 second, Mike.
Yeah, no problem.
Completely lost my audio. Hang on.
Oh, that's okay. I can hear it well now. You sound great. Oh, you can't hear me.
All right, I'm good.
There we go. Much better, actually.
All right, good.
So back to what I was saying is for you watching right now or listening, what is important about what Phil does and what he provides is he's got a fund. So he's an active trader with his company. He also has training, and it's virtualized, which is awesome. It used to always be in person. And so there's sort of like a do-it-yourself, learn this process as well as a done for you. And what is really interesting about Phil is he does use what has been called the Warren Buffett value, but he's got a bunch of other techniques and strategies. Plus, he's very, very consistently predicted and been able to predict is a bad word to use, so I'm not going to put that word out there. But you do have a crystal ball. You've got the benefit of history and a clear mind, and you think properly, which I think is something that us lay people oftentimes don't do. So when you combine those with strategy, technique, plenty of resources, and a lot of history, you got a winning combination. So with that, I'm going to get out of your way, Phil, and let you pull out your crystal ball. So what do you got?
Yeah, crystal ball says that that there are several things that we take a close look at when we're trying to understand how aggressively we should try to be out there buying companies, right? So the first level is, can I find wonderful businesses that are on sale, businesses that are durable, they're going to make it through a big recession or a depression. They're anti-fragile because they've got some intrinsic characteristic that protects them against competition and keeps their margins up. So we're looking for very specific kinds of businesses that can get through rough times. And those turn out to be great businesses in good times as well. So we're looking for those. And when they're not on sale, that's a clue right there that the market is not at a price point where we can just jump in and buy anything. All right. Then the second thing we look at is called the Buffett indicator, which Warren talked about back in 2001 in one of his lectures. And when he was talking about where it gets scary with regard to the revenue of the United States, which is called GDP, gross domestic product, and the price of the market, which is typically, we would look at the Wilshire index, which is all the stocks in the market pretty much. And if you compare these two things, first, here's the revenue of the country and here's the price of the market. There's got to be a relationship with these two things because, the revenue is a lot of these companies is doing the revenue. And there is indeed a relationship. It's typically the market is considered to be priced pretty properly when the price of the market is about 80% of GDP. Okay, so if GDP is 20 trillion, if the market was at 16 trillion, that'd be about right. Okay, and the market today is at 32 trillion, which is double historically pricing the market, being driven there by zero rate interest rates and very low bonds and nowhere else to go for yield. And so the market has been artificially driven in a version of insanity, way higher than it should ever be. Not to mention the fact that when Trump gave back this huge tax benefit to corporations by cutting the taxes down to 20%, those idiots didn't hire people. They didn't build capital expenditures. They went straight out and bought back their own stock and gave themselves bonuses, which drove the stock up further. Then when interest rates went to zero, no, those guys, they didn't think about getting rid of debt. They thought about buying everybody else in their industry with zero rate interest rates and loading up on debt. So right now, corporate debt's higher than it's ever been in history. These boneheads have taken one of the great boom markets in history, nothing but good news, and turned it into a really precarious financial situation. As if your job at home, you're getting raise after raise after raise. And what do? Do you save money for retirement? No. What do you do? You spend it all and borrow every cent you can based on your income. That's what you do. And that's what they've done. So now we've got this market that's stupidly high priced, clear up here in Insanityville. And that's called the Wilshire GDP. It's at 178% of GDP right now after the market crash. And historically, it's about 80. And it's been as low as 20, right? So it's just massively overpriced. And then the third thing that we look at is called the Shiller cyclically adjusted PE ratio, which is a really sophisticated analysis of the last 140 years of stock prices done by a Yale professor named Robert Shiller, who got the Nobel Prize in 2013 for this thing. And it basically says very clearly that the market is reasonably priced at around a 16 Shiller. Historically, that's been where the average is. When it gets above 24, you're in la la land as far as a market pricing. It's only been above 24 four times now, in history, in 140 years of tracking this, 4 times above 24. Once in 1929, once in 2000, once in 2007, and today. And in every case, we had a market drop of at least 50%. In the case of the Great Depression, it went down 90%. So we are precariously balanced, massive debt in all these corporations. They have been driven there by artificial interest rates. And now along comes a coronavirus, a pandemic, and has put entire industries out of business for a big chunk of time. And the impact of that is going to be felt for years. And what that means to me as a stock investor is the prices I briefly saw in March, where I could start buying, I got some cash into the market before the whole thing turned around. Those prices are going to look like not such a good deal in about a year. And this is pure crystal ball BS from me. All right. I wouldn't go to the store with this, but watch and see what happens a year from now as all of these earnings disappear, as these guys are having trouble making their payments, as 40% of the S&P 500, which are the biggest companies in America, are negative earnings before the pandemic, loaded with debt. So you're going to see Chapter 11 bankruptcies left and right. Okay, Neiman Marcus just went Chapter 11 bankruptcy. Okay, so this is the beginning of one after another of this snowball rolling downhill, picking up speed. And what's going to happen is the baby boomers are going to get scared as hell that they're not going to have the money they've got right now to retire on, to stay retired. And they've been looking stock market, because I can't get anything in bonds, and they're going to change their mind. Over the next year, they're going to get scared. And that's going to mean pulling that money out. That's what drove the market for 30 years, and they're going to pull it out. And when they do, all those indexes that all these people are in are going to drop like a brick, and we are going to see a market more like the Great Depression than like in the year 2000 or 2007. We're going to see this thing crater. And it is going to be a time when fortunes are lost. It's going to be a time when fortunes are made. And it's just depending on whether you're ready or not for this to come at you.
All right. So I'm going to get selfish with this right now, because what I did is I pulled out right shortly after, but before the cratering. And I sold all my stocks and equities. And I've been just standing on the side right now. And Vivian and I lost very, very little in this because of the way we've got our wealth structured. And I have observed some people, like I pay attention to Reddit and Wall Street and that kind of thing, which I always take with a grain of salt, but there seems to be some people who are knowledgeable in there and listen and pay attention. That the belief is right now, as soon as the pandemic happened, because so many people are at home, there's a record number of Robinhood and other accounts that have been open. And there's a whole bunch of stupid money in the market right now, which is by this guy's prediction. And he laid it out with what seemed like some logical data. I didn't double check it, but he basically said, there's so much stupid money in it right now. All it's going to take is something to scare it out. And then that's still before what you just discussed, which is when the earnings come out and the rooster comes home because of the circumstance, all the buybacks and all the other things that have happened. So with that in mind, if you had a gut right now is in terms of when you'd anticipate the bottom to fall out and how long things will crater. We don't have a historical precedent necessarily, and the market is strange as hell. But, for ordinary folks like us, um, what's your feeling? What would your recommendation be, and what training and education should we get while this is going on, so we're prepared to take advantage of the cratering and the big dip, the inevitable?
So the first thing I would say is that you want to be in cash, but you don't want to be in cash for very long. Okay, so very long would be like years. You want to be in cash because that's going to be the vehicle to get you into hard assets. Hard assets being something that will produce cash in the future, and will be able to handle the inflation, which is probably 4 or 5 years down around the road. So what you want to do now is take advantage. Get down on your knees. Thank the good Lord for bringing the market back so quickly, and just realize that if you're not taking it out at the top, you're taking it out at the top a year ago, which is close enough. And you're in a market right now which has very, very little likelihood of going up and a lot of likelihood of going down. So if you want to play probabilities a little, you get out of the market here. All right, that's the first thing. So now you're in cash. Then I think you're waiting patiently. I think you're going to spend the next year learning a lot about what to invest in down the road. And then I think a year from now, I would have said maybe a year and a half, but in the Great Depression, it took about a year and a half to get to the bottom, all right, from 1929. And my teacher's teacher, so this is Warren Buffett's teacher, Ben Graham, said this lament in 1933. He said, yeah, I had cash in 1929. The market crashed, and I got in as it went down about 30%. He said, it doesn't feel any better to get in at 30% when it goes down 90% than it does to just stay in having it go down 90%. So you want to be patient here. It's going to take a big drop, and it's going to take time. It took a year and a half in 31 to get to the bottom, and the bottom was 90% down from the top. All right. I don't think we're going that far down because we have a lot better cushion with the Federal Reserve being very aggressive with money right now. But it's going to go down a lot as all these companies start turning in really crap earnings and the whole economy slows down. So Wall Street responds to that belatedly. And then if you stay, and so I'm thinking, I don't know, I think a year or so. And then what you want to do in this intervening year, this is just my opinion, Mike, but this is what I would do, is I would stack up, I would start reading like a maniac about companies that I think I understand. So if I'm down, I'll go use Chipotle again because I love Chipotle burritos and I've owned them over and over again. I would come to understand that company so well that if I wanted to own a Chipotle franchise, they don't franchise, but if they did, I would be able to own a Chipotle franchise and pretty well understand the whole picture, right? Just as if you were going to buy one. You're going to buy into this company as if you're going to own the whole thing. So you need to understand it, and that takes some reading. And what you're looking for, not to hype Chipotle overly, is a company that is what Nicholas Taleb calls anti-fragile. This guy's a New York University professor. He wrote 3 fabulous books about the market because before he became a professor, he was an options trader on Wall Street, made millions and went off. He said nothing on Wall Street compares with the fierce competition in the faculty lounge at NYU. It's like Wall Street.
Really.
Wall Street's a walk in the park. It cracked me up. So Taleb wrote a book called Black Swan and another one called Fooled by Randomness, but his magnus opus is called Anti-Fragile. And it's where he describes the kind of thing you want as you're coming into deep adversity and a lot of turmoil is you want to own things that don't just withstand all of it, but get stronger during it. Right. So what would cause a company to get stronger? Well, it has a position in the industry that's so protected that its competition is going to falter during this enormous economic change. And as that competition falters, this company is ready to buy them up and take over their piece of the market. And they'll emerge on the other side of this bigger, stronger, better than ever. They will have picked up the best people. They will have gotten rid of companies that have a lot of debt that can't compete because of the debt, and they will be so much stronger. So this is what we're looking for. We want it, and I want you guys to look for it too. And if you're building a company, I want you to build that kind of company, something that does, not that it necessarily is making more money during the adversity, but it is building its niche stronger. All right. I'll give you an example. I'm not going to even tell you the name of this.
Yeah, that's what I'm looking for. Some good examples of what you're spotting right now. Like I'll give you for example that I've been monitoring. I bought a bunch of the stock. I sold it just thinking, I'm going to just see what happens here. And I got out and made a little, but it was Peloton. And the reason I bought Peloton is because I have one. I love Peloton.
Right.
And I just saw something in chat from Alex saying Home Depot is another example. But Peloton, the reason I got turned on to it is I saw an interview where a guy said he considers Peloton one of the biggest and best wearables in the world because they've got proprietary hardware. They've got a platform, something around $1 billion in revenue. That doesn't mean they're making money because they're big, they're public. But the stock dipped down. It was like, when it came out, it was on $18. And I bought it around 22 or so during a big dip. And right now, I just checked yesterday, it's over $40. So many people are at home. And if you look at the riding patterns, I mean, there's 3 times as many people on the bike in real time because you can see how many people are taking the classes. And it's a perfect device. And my prediction is, what are they called? Fitness studios. I mean, how are they ever going to recover from this? The big ones anyway, right?
Right.
And so that's an example. And I just wanted to throw that out and just ask you, is that thinking right? Or throw out some examples here because I want to also get some people in chat lining up and giving us some thoughts and feedback too, just to create.
So I'll ask you a few questions about it. Since I haven't dug deep into Peloton because the problem I would have with buying it is trying to figure out what to pay for it.
Yeah,
and this is always a problem for me on companies that are relatively new. So we tend to be more with the old school companies that have been around a while, and we can kind of get an idea where it's going to be in 10 years. And Peloton's very richly priced because a lot of people are saying these guys have figured out a niche. So the first thing I love about what you said is they're a niche player and they're very hard to compete with. You can cut price on them, but they don't have to cut their price to match your crap price because they've got the right approach to this whole thing. That's called a moat. And the moat that we basically look at 5 moats, Mike, and just tell me where Peloton fits.
All right.
Are they the low cost guy or the low price in the industry? Nope.
Not at all. They're definitely premium, and everyone else that I've seen is crappy. So they've got that. The user experience is outstanding.
They're not going to be the Costco of exercise equipment. They're not going to be the Walmart. All right. Is this the only place you can go to get an exercise bike that you'd use at home?
No, it's not. But their competition, from what I see, they're not very well integrated. And when I look at them, people complain about them, because their tech doesn't work very well. And they also have talent. They treat their people like entertainers, and they are good entertainers.
Sure.
So, and it's on demand, it's live or recorded. So they have a huge library.
So you could say, well, I could go down to my exercise gym and I could get a cheap bike and I could put on a YouTube video and, I'm doing exercise. So we would say, okay, they don't have what's called a toll bridge moat. It's not the only way you can get to San Francisco from Sausalito.
That is correct.
You could go around the Richmond Bay Bridge and then around the Oakland Bay Bridge, and you could drive into the city that way and not pay a toll. But it's stupid. You would never do it. So we would say, no, Peloton doesn't have that good of a moat. That's more of like a utility or maybe an airline or a railroad, something like that. All right, they don't have that one. All right, next one. Do they have a secret that's some patented thing that only they can do that's so important no one else can do it? Do they have one of those?
That I'm not sure about. But I'm going to speculate and say I instinctively would think they'd have something, although technically, again, it's an exercise bike with sensors, a big screen, and a subscription service. They're like a Netflix. They have a ton of content.
Yep.
And a big library.
So we'd say, okay, they don't have the kind of protection from a government patent or some secret that nobody can figure out. All right. So that we call that a secrets moat. So they don't have that. are they difficult to move off of? Like, for example, if you have, let's say IBM in your back office as a bank, and you've got all their equipment and you've got all their software that they built specially for you, it's impossible for you to move away from them, even if Microsoft is better, even if AWS is better, doesn't matter. You're stuck with IBM. We call that a switching mode. If you start Peloton, is it hard to just move over to a different bike that came along that does it better? If one did.
Yeah, you wouldn't be able to. So it turns out I've studied this stuff. So I have like my Apple Watch. I run that. I also have an Aura ring. So I've got data going in and collecting all the time. And they have the way they're set up. It's sort of like Facebook. So you build friends and followers and followings. It tracks all your data. And unless you're really technical, there isn't an easy way to get the data out of there. And part of the appeal is like, after you've ridden 100 races, you get a t-shirt. They've got the communication and the community down. And as far as I can tell, there's nothing else that remotely comes to the community. So you come for the tech, you come to work out, you stay for the community because you can interact in real time. So you actually feel like you're participating in a show. So yeah, I'd say
if you get hard to leave. Instructor too, you probably get hooked into an instructor or somebody you really enjoy.
Yeah, totally. Yeah.
I think that's a switching mode, my friend, because the last one is a brand mode, and Peloton hasn't been around long enough. They certainly have a brand, big brand, right? But brand modes can come and go. I mean, those are.
I got it.
When you think in terms of an exercise bike, in terms of Peloton, then they've got a brand, and I think people do. I certainly do. If you're to say what's an integrated, on the screen and everything, I just think Peloton. And now you got guys who are doing rowing machines and said, we're the Peloton of rowing machines. That's a brand. So these guys have a brand mode and they've got a switching mode. And that combination makes them very attractive over the long run, right? So now you got to look out and say, okay, here they are right here in 2020. Will they be bigger in 2030, or will this fad fade? Will somebody else come along that's even better? How sure am I? Am I as sure that they'll be bigger in 2030 as I am that Chipotle will build another 2,000 restaurants? And that might be harder to answer.
Yeah. No, they're again, this is complicating the conversation a little bit, but it's interesting.
We're deep in the weeds here right now.
We are, but we're getting some good feedback. But there's a guy named Scott Galloway who's an NYU professor. He's the one who said he considers Peloton to be the best fitness wearable, and he predicts and thinks Apple should buy them. Cool. because they've got so many users, they're so engaged, they're on proprietary hardware. So he sort of likened them to being the Apple of fitness. And
so Mike, what I would do is I would look at that and I would say, look, this business is too difficult for me to know where they're going to be in 10 years, but it
totally makes sense. Yep.
And so I'm going to do this one. If I was going to do it, I would say this is part of my risky biz portfolio. They don't have a long track record. They are absolutely creating a niche, and I really want to own them because they're fun and I like their product, and I'm going to put them in the risky biz portfolio, which for me is about 10% of the portfolio. So
got it.
I'm going to park them over there and roll the dice because that's what makes it's fun to do that, right, with these guys. But the majority of the portfolio cannot be in companies like that. It has to be in companies that are absolutely rock solid, put my last penny in them, and I'm going to be fine in 10 years. That's the level that I've got to know for sure about these companies.
Right on. So why don't you break down one that you've got your eyes on right now that you think's sexy, using all the rules through the Phil Town methodology?
That's really hard for me to do, my friend.
All right.
You know why?
I figured I'd push you. Yeah, go for it.
Here's the thing. I own several of these now, and if I don't own them, I want to. And the ones I already own, I want the price to go down. And so if I own it now, with a certain amount of the portfolio, I'm saving up cash to buy more of it. And so I really want to see the price go down. If I tell everybody, hey, here's this company, go take a look at it and blah, 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 price will go up potentially. So, but here's the thing. You guys aren't a whole bunch of fund managers, and it takes billions to move these companies around. So I'm going to give you one example. All right. And you guys
that sounds great.
I'm doing this because Mike's my friend. I don't do this ever otherwise. But
All
I'm
right.
gonna do this one time. All right. So banks have been crushed by what's going on here because everybody's scared to death people aren't going to pay their loans. But there's a regional bank out there that's run by a guy named George Gleason. I'll tell you what, I'm not even going to tell you the name of the bank. I will tell you the name of the CEO. And if you don't have the motivation to go look up the bank off of this information, then you didn't need to know it anyway. All right. The CEO was a 25-year-old lawyer when he bought the bank. And it was just one branch, and he bought it for $3 million, and it had like $25 million in it. It now has $20 billion in it, and it has 240 branches out there. In 2008, he acquired 14 other banks that had failed in that recession. They have never had a year they weren't profitable from the day he took them over. They were rated the #1 bank in the South in 2019. They're rated one of Forbes' best banks in the world. And they're a bank you never heard of. I promise you never heard of them.
Yep.
And this guy's business is so well run. He runs a bank the way Warren Buffett runs Berkshire Hathaway. He camps out on cash. He waits for everybody to get out of his way who were following some real estate trend or whatever. And then he only works with the very best developers in the world. He makes them put in $1 for every dollar he puts in. So the worst situation he ever has is if they fail, he gets the project at a half price of the construction cost. And then he also sits on cash and waits for banks to go broke in a recession. And he has built this phenomenal bank. And man, that thing is so on sale right now. It drives me nuts. I want to buy more, but I already loaded up on it. And then I'm going to have to just wait for it to get even more on sale, I think, before I can justify even loading more in.
Wow. Okay.
Rohey Sharma, you nailed it, but don't tell anybody.
Yeah. Good. I love it. Well, that's, should I mention the CEO's name again, or do they have to go
Sure.
back to the replay?
George Gleason.
George Gleason. Yep. There you go. Do a little bit of searching. Okay. That's awesome. So, next up.
Now, wait. We got to cover one quick thing.
Yeah.
Now, what makes this bank anti-fragile as opposed to, say, Bank of America, Wells Fargo, Citi, all of which, JP Morgan, they'll all be around in 10 years, I'm sure, and they'll probably be bigger. So there, you don't go far wrong if you bought them right now. But what makes these guys particularly special is that they run this bank to be anti-fragile. They don't do well if you look at their just quarter to quarter earnings and just growing a nice steadily like that. They camp out and wait and lurk and ambush. And it makes them anti-fragile. When the fit hits the shan, all of a sudden all these deals are around. Most banks are pulling back away from it because they're the ones that are losing all their loans. The loans are going bad. They don't know what to do. They get these guys. No, the loans are still good, and they got cash, and they jump in. And that's what anti-fragile looks like. And that's why they'll be much bigger in 10 years than they are today. Yep, that helped.
Yeah. And part of the secret sauce really comes down to the psychology of management and the human side. It's the hard to quantify part of making these kinds of decisions, and why getting an education is so important.
Yep.
And that's very good. So we've got some good chat. People figured it out over here, but we're not going to say it live. So you either did your research or you didn't.
Yep.
So do you have one thing that I want to just reveal to everyone right now and share with them, because we'll continue on with a couple more tips, but I do want to tell everyone about your training, and I'm going to pop that in chat so they can learn more about it while we talk about it. I'll actually even put it on screen, but this way, about Phil's training. And if you see in text, I just popped it in right now. The link is I set up a short link. It's paidforlife.com/PT, which stands for Phil Town. And that's where you can master the market from home. And I'll even show my screen so everyone can take a look at it. But why don't you talk a little bit about the training and the program, how you actually virtualized as well? You started, in the past, you always did everything live and in a big stadium and taught people investing strategies. So you'd walk out with the knowledge, but now you virtualize it. So it's a lot easier. And I know because I'm friends with Eric and the team, this is you guys are having record results because so many people are showing up.
Yeah, it's really unbelievable what's happened. To this point, as you say, we do everything live, and we're sort of restricted by the number of coaches we can put in the room. Our coaches are all people who have gone through the class and have done well with investing over the last 2 or 3 or 4 years, and then want to volunteer and be a coach. And they go through our coaching certification program. And we like to have a really high ratio of coaches to students, because when we teach, we're going into some really deep ideas, and you need to work through them on your own computer, doing your own research, or you're going to go home and wonder where to start. So we like people going through this 3-day program that they come out the other side of it really fully understanding how to go out and find good companies that would be right for them to invest in. And so our coaches are an integral part of that. And we go for an hour of lecture or so, and then with examples, and then we break and go right into a process where the students are doing it themselves. And so you need coaches for that. And so we would bring everybody to Atlanta. People would come, and back when we started, we charged $4,000 for the course, and we did it around the world, different places, for $4,000. And then gradually we basically went away from that model to where we were having people come to Atlanta on some form of a scholarship. We'd take away anything from part of it to all of it, and understanding they were paying for flights and they're paying for hotels and the whole deal.
Yeah.
And we don't sell anything at the workshop. We just absolutely want you to go through the 3-day process without worrying about what to do next. And then at the end of the 3 days, we start you off on a program that's lasting a couple of weeks, and you'll be working to develop your skill set over that period of time. And we find that a lot of people are really comfortable just going on from there without any more help from us. We've got 3 books out there, we've got podcasts and all that, videos. And other people want more, and we have more help there for them. But the 3-day class is just focused on learning. So when this pandemic hit, we thought, how about we ask our coaches if they'd be willing to coach for 3 straight days at home, again, just volunteering to do it on a ratio of 8 to 10 students per coach. And we just, this last weekend, we did our 3rd version of this, and we had 500 people in there. So we had over 50 coaches. I think the total number of coaches were about 80, because we've got coaches who are learning to coach on top of this. And we decided to charge $297 for the whole thing, which is,
so basically from $4,000 to $300,
Yeah.
and you've got a hands-on workshop with live coaches, and you're trading starting on the first day.
Yeah.
And so that means you're being taught to fish. And Jeriam, who's here right now, said he was there for the last course and last month, and he said it was awesome. So we've already got a fan right here who's watching.
Man, thank you. That was very cool. Yeah, I really appreciate you guys saying that. We have a lot of fans out there, and we're real excited that you guys are able to learn. I think what a lot of people are concerned about when they come to class is one of 2 things. Either it's going to be so basic you won't learn anything, or it's going to be you're over your head and you won't learn anything. And we're really good at this. We've taught, I think, something like over 12,000 students now in the live 3-day class in Atlanta. And doing this virtually, we've discovered is better than it was. It was better for the students than it was in Atlanta. You get about 7 hours of, small group one-on-one time with a coach who's super good at working you through the weaknesses and the problems that you're having to make sure that you're ready to go to the next stage all the way through the 3-day class. And I promise you'll start off, I don't care if you're a hedge fund manager, you'll start off and very quickly you'll be into concepts that you're unfamiliar with, particularly if you went to Harvard. None of these concepts got taught at Harvard, right? In fact, one of the things I show at the very beginning of the class is a lecture by Lee Lu, who is one of the top investors in the world. He's compounding money at 30% per year for the last 20 years. He's the only guy Charlie Munger's ever put his money with besides Warren Buffett. And was one of the guys at Tiananmen Square in 1989, standing in front of a tank. And he escaped out, went to Colombia, saw Warren Buffett and said, I want to do that. And he became a ruler type investor, a rule number one investor, which means you focus on not losing money. And he's brilliant at it. He goes to Colombia to give a lecture. And by the time he's been there an hour, he's telling these students who are Columbia Business School students who are in the end of their second year, who are going to Wall Street, he's telling them, I don't know how you people think you're worth $150,000 a year. You don't know anything. You don't know the basics. He said, this is why I won't hire you. I hire people who do not have your education, who do not work for some institutional fund manager. Most of them don't even have any accounting experience. And I teach them the right thing to do. And so it just should tell you, if one of the best investors in the world is out there saying, look, you can do this better than the people on Wall Street because you haven't been corrupted and screwed up with all the wrong kind of information. We will teach you how to be an investor the way you would be if you thought of as being an owner of a company. And this is just Warren Buffett 101. And if you spend the 3 days with us, I promise you'll come out of there one of the best investors in the world. Absolutely no question about it.
Well, it's a total no-brainer. And one other question that I have for you, Phil, which Victoria asked is, does this work for people internationally too?
It does. There are, I think, something like 84 stock markets that Interactive Brokers has access to, which is the brokerage I use. The information we'll be teaching you is, a lot of it is compiled rather nicely and packaged up in our toolbox that I built so I don't have to do as much, daily kinds of work with an Excel spreadsheet. But in my book, Rule Number One, I walk you through all of the math you need to do on an Excel spreadsheet that you could do with any company anywhere in the world. And our students are, in fact, from all over the world. When we were doing this in Atlanta, we had students coming in from everywhere. And when we did this virtually, I couldn't believe it, man. I bet you a third of the students in that room were from other places in the world besides the US and Canada.
Yeah, it makes total sense. So the net is, you come in 100% virtual, work at home, you get lectures and training from you, then break into breakout rooms and work with coaches, and you set up and actually start trading. You learn the techniques and you learn a bunch of strategies that are both short-term, long-term, but you understand why and how to invest. It's not like you're pulling this out of nowhere.
Yeah, it's not a black box. You're going to understand very clearly how you should go forward. And in fact, we begin on day one. You'll be in the room with your coaches at about 2:30 in the afternoon. I start at 3, and we're gonna go right till 9 o'clock at night on a Friday night, and then it's all day and into the evening on Saturday. And we're finished by about 6 o'clock Sunday. So it's really, really a lot packed in there. And the first thing you're going to learn is you start right where you are. That good investing is about figuring out what you love to do, what are you passionate about in your life, what do you care about being in the world, and focusing on that and expanding it and making it bigger and bigger and bigger. And so we start you off with that. We do what's called the 3 circles exercise right off the bat, which is a computer-driven analysis of what you love, what you're passionate about, where are your talents, where you spend your money. We throw that all into the computer and it starts spitting out companies that are right for you. And it's really cool.
It's awesome. Well, I've seen the back end of the system and the software. It's really, really impressive what you guys have put together. So at this point, what are some other questions that people typically have for you, either about the course and the system or just in general, that get them off the fence?
I think the biggest thing is for a lot of people is the same thing that was a problem for me when I first started thinking about doing this is now I don't have the money or the time. Like, okay, if I don't have the money, why should I be doing this? And I think the answer is the same one my teacher gave me back in 1980 when I was a river guide. He said, it's not about the money, it's about what you know. He said, I'm making $4,000 a year at that time. And I'm thinking it's got to be about, I don't have any money to invest. And he says, no, it's not about that. It's about what you know. And that turned out to be absolutely true. And that was the same thing with Warren Buffett. It's the same thing with my teacher. And it's not about money, you guys. It's about knowledge. And frankly, the more you learn, the less you have to work. And that's just the truth. So Um, don't let that stop you. And then the second thing is, I don't have the time to be an investor. And this is actually a pretty significant question. I mean, most people are pretty jammed. There's particularly, you got kids at home, you're trying to figure out how to make your life work. And you're trying to think, okay, am I going to add something as significant as this? And I think for a lot of people, it probably is just the way it goes. You're not going to make the time. It's more like, I'd like to do it, but I really can't. And they don't have that kind of commitment that I think this will take. I think this is something for people who are committed to something more than a goal of being financially independent. I think if you're ready to make a promise to yourself that you will be financially independent, you will achieve a life that you want to live, and you need a certain amount of capital to do that you will do it. If you're at that stage where you're saying, and this is the stage I was in 1980, that Dr. Jonas Salk, who's a San Diego guy, Mike, and who died not too long ago, Salk Institute, was one of my first mentors up there. And he basically told me, look, it's not about a goal, it's about a promise. And you have to make a commitment. And when you make a commitment, you will be amazed at the miracles that start happening around you for things that you could have never expected or dream would have come toward you, just start coming to you because of that commitment. If you hadn't made the commitment, they wouldn't have happened. And I don't know what the magic is, but I know it works. And if you're ready kind of at that stage, you'll find the time. And so if you want to know how long it'll really take, I'd say following the class, if you gave it an hour a day, you would be able to complete all your homework assignments in the time allotted. I think when you've done an hour a day for 2 weeks following the class, you will have started to anchor a discipline. And that discipline will continue to grow as you start to see success of building a watch list of 5 or 10 companies, an hour a day, a couple hours a week, whatever you can do, building this watch list. You've got about a year to get this together. And if you did get it together in a year and have a nice group of companies there, 5 to 10 companies you really understand, and you know what to pay for them, when they go on sale, it's phenomenal. There's no fear. There's just like, yeah, pull the trigger. And just on that point, Mike, we did our first class, ironically, in June of 2009. And I'd just been on CNBC in March saying, okay, I'm getting back into the market. 2007, I went on with Maria Bartiromo, so I'm getting out of this market. It's too expensive. The big guys are moving out. I'm out of here. And I was out of it for about 18 months, just like we are pretty much right now. And then in March, we started going back in aggressively. And so in June, we did our first 3-day class in Singapore. And the students built a portfolio. And that's what you guys are going to do as well. We're going to build an anti-fragile portfolio with all the students working on it over that 3-day period, feeding in their pieces. And then our coaches gathering in to screen the finest companies of all out of that and build a 10-company portfolio. We did that in Singapore. And the result of that portfolio, had you put in, let's say, $100,000 into that portfolio, 10 years later in 2018, when we pulled the trigger and closed it as the market got too expensive, that portfolio turned that $100,000 into $1.25 million. The market turned that $100,000 into $300,000.
Nice.
So the difference is how you're going to live in the future, just phenomenally different if you can just use this next year wisely and prepare yourself for, I think, an opportunity of a lifetime coming at you.
Well, I'm in and I'm super excited. I really am. So what I'll just tell everyone watching at home right now, if you're here with us and with me, right now is the best time to get in. I don't think you'll ever have a better chance than right now because of the market situation, the market conditions. You've got an opportunity when, for all practical purposes, this may be the lowest the market ever will go in the near future. So that means everything's going to be on sale. You've got the perfect teacher at the perfect time. And I'll also say that I know this, but I want to verify it, but I believe that you can also do just paper trading as well during the training. So you don't necessarily have to trade real money. So you learn the skills and talents that way, correct?
Correct. Yep,
Yeah.
absolutely right.
So that means there's no risk.
Right. There's no risk. We don't want you guys going out to do something where you can lose money. And by the way, we will send you home with one of the most wonderful sort of trades that we developed over the last decade to start with. You're going to learn how to start to create cash flow starting with just, $1,000 or something. And you can learn to do it very well using paper trading tools now that are really, really effective, where you can back test and get really good at something before you ever begin to use real money. We don't do any kind of sort of risky things out there. What we do is we try to take advantage of the market when we know the value of something and buy in cheaper. And we're going to show you guys how to do that. And I just want to say one more thing really quick. Kathy is basically saying, look, I'd love to do that, but I've got a religious commitment over the weekends all the time. Is there something we can do apart from that? And Kath, the problem is that the advantage of this workshop over just, books that are out there. I mean, you could buy my books, happy to have you have them. And you could work hard to work through what we're going to teach you guys by using those books. But the advantage is having a live coach that's going to say, okay, here's the problem I've got right now. I'm stuck and I don't know what to do. And that's where people fall off their wagon, right? Is they get stuck. So let me promise you this, down the road, we will have enough people like you who the weekends are something they can't really do. And we'll run a midweek class, because now that we're virtual, we can do that. We don't have to have hotel reservations 8 months in advance and all that kind of stuff. So I promise you, we'll run a midweek class, and if you'll keep track of us, we'll be sure to just get you into that class for sure.
Awesome. So, well, we're at the top of the hour. Besides just telling you this is a great opportunity, Phil's a friend. That's why I did this webinar. I love who he is. I love what he does. There were just one interesting question that popped up just to finish. What are your thoughts on crypto? You want to go down that rabbit hole for a second?
Yeah, you betcha. Yeah. So crypto is trying to become a form of money, right? And a form of storage of wealth, first of all. So we'll say storage of wealth that is beyond the reach of government, in the way that even gold is not. And if you guys are familiar with this whole story, and by the way, I just going to preface this by saying I'm not a crypto guy, so I'm just going to tell you as an investor where I'm looking at this, is that in 1934, a lot of Americans in the last depression were very nervous about currency. They saw the banks fail, and they wanted to go to something that was safer than a paper dollar, and they went to gold. And the government saw that when people went to gold, they just stored the gold, they just held on to it, they didn't consume. And what they were desperately trying to do is get people to consume, to use the money, because your $100,000 of spending is John's $100,000 of income. And when you forget that, you don't spend the 100 grand, that guy doesn't have a job. And that's what we're going to see over the next year or two. But that's what FDR looked at and said, oh man, we got to get people out of gold. So he confiscated all the gold in America to turn it in or go to jail. And he paid, I think, $20 for it per ounce, and then turned it right around and repriced it to the market, which was double that. So in other words, he confiscated half of the wealth in America that was sitting in gold.
Sounds like an evil bastard to me.
Yes, very sneaky. Okay. So the first problem you've got with crypto or gold or any alternative to the dollar or the currency of your country is that your local government is going to be very jealous about keeping you in their currency so that you'll spend their currency. So right now, it's not easy for them to figure out crypto, which makes crypto in one way more interesting than gold. Okay. Although not as widely accepted in the sense of this as a value. What the hell gives gold its value? I don't know. People have used it for value. That's all. So the same thing's going on with crypto. Now, there are other problems in terms of trust. If I've got a bar of gold, somebody's going to want it, right? And you can argue the advantages or disadvantages. If I've got crypto, I've got to hope that there's a market out there for it, that other people will want it. And as we have government confiscation, more totalitarianism, which we will have in the future, as a result of the kind of problems we've got economically, you get the rise of totalitarianism. You're going to see, I think, a lot of people go towards something that governments can't get their fingers on. And so as much as I'm not in it, I don't think it'd be a bad thing to trade. If I was a trader, I might be very, very interested in crypto. So I'll leave you guys with that.
That's really good. And it looks like Carrie and Victoria and Kirana are in, and Timothy is. So this is great. Kathy says she's going to pass it on to her tribe. And if you're watching right now, I'm going to follow up and send you a replay that's on YouTube. It actually will be the same link you registered with, but we'll send you a follow-up video or link. Here's one that popped in from Tammy, and I'll just ask this because why not? She's asking about holding hard assets like property. She said vacation property. And then she combined that with, she's Canadian, so the value of currency, Canadian versus the dollar. Do you have some thoughts on that one? I think it's an interesting question.
Yeah.
Not stocks, it's not securities. Yeah.
And multiple levels of it as well. And so here's my first level of thought is that I've just said go to cash, right? In my opinion. By the way, this isn't advice or recommendations. You know, seek an advisor who knows what you're doing if you don't. And but it's my opinion, and that's what I've done. So I'm walking my talk here. And but I don't want you to stay there. And the reason I don't want you to stay there is because the federal governments have figured out that it's better to have inflation than deflation. And they have been fighting deflation now for a decade, with more and more money being poured into a dark hole, and looking for some degree of inflation to start to build up to get a sense that, okay, now people's wages are expanding and they got better jobs and all this. Well, you just got another hole blown in the ship of inflation. That means deflation again. People's lost their jobs. Way more people looking for a job than have one. And so if I want to hire people, I don't have to pay more. I can pay less and get people in there. And the federal government's very concerned about that. So what they're doing is to kind of keep a level playing field in a place where for the last 10 years, they've been making rich people richer and poor people poorer. They're now everybody, some Republicans are dragging their feet, but the president isn't dragging his feet and the Democrats are not dragging their feet. They want to pour money into this environment. And they've already committed $6 trillion, which is 50% more than they did in 2008. And they'll pour more. If they need to, they'll just keep printing until we have some form, I think this already started up, of universal income and some form of nationalized healthcare, because we're going to be screaming for both of those things. People are like, I can't live on $10 an hour. It's particularly if I got to pay $1,000 a month in health insurance premium. So we're going to see a dramatic push for all of that. And that all takes money right at the time when we don't have any. So now they're going to tax rich guys a lot more. Okay. So Warren Buffett says, yep, I'm okay with it. Tax me. And so does Bezos. And so does, and so do guys like me. And so do guys like Mike. We'll say, okay, fine, we'll pay more. But if you took it all, then we're not going to work for a living. And then you don't have companies. So now you can't take it all. You can only take so much. And that's not going to pay for all this stuff. So now they're going to print. And here's my point. When they print to meet the deficit spending of the government and universal income, which we've already started, right? And you got people who don't want to go back to work because they're getting more money at home right now on unemployment than they were working. And when you pay for nationalized healthcare, you're going to have to print money. And when you print money, eventually you get inflation. And as you get inflation, you don't want to be in cash. All right. So that's a long way around to tell you, yes, you want hard assets of some sort. So what's a hard asset? Well, a company that makes energy is a hard asset if it produces cash flow. A company that makes burritos is a hard asset if it produces cash flow, right? If you owned a McDonald's franchise, that would be a hard asset that produces cash flow for you. And you have the ability with that franchise to raise your prices as your costs rise because it's a big brand and people want Big Macs, all right? If they didn't want Big Macs, you couldn't raise your prices, but they do, so you can raise your prices. Coca-Cola, when I was a kid, was 10 cents. Today, over $1. So if you have a big moat in this company, it's a very solid asset, and you move your money into it. Now your money is out of dollars effectively, and although it's the price of the stock is in dollars, your asset is going to rise through inflation. Even if they devalue the currency, they're not going to devalue the company because it's producing all of this cash flow. So you want cash flow producing assets. Now that steers you a little away from gold, a little away from crypto, because those don't produce cash flow. The reason we want, tell me if I'm going too long here, Mike, but the reason we want
no, this is fine. It's good training. And we got a lot of people saying, yep, Love this. Love this. Love this. It's good.
Okay. So here's why we want cash flow. It's because I can tell what to pay for it, right? I'm buying cash flow with my money. So I could go buy a currency. I could go buy gold. What's the relationship between the Canadian dollar and the US dollar? I don't know, 70%, 68%. Was it going to go to 100%? I don't know. Is it going to go to 50%? I don't know. So what should I pay for it? I don't know. Okay. But if you ask me what to pay for a burrito company, I can tell you because I'm buying the cash flow at a certain yield on my purchase price. And so if I own a business or if I buy a laundromat or if I pick up a franchise, I know what those are worth. Those are hard assets. Now, you just got to make sure that you're buying the kind of hard asset that will go through a depression. That's the key. It's an asset that will go through the depression and maintain its value and be worth more on the other side than it was going in.
Outstanding. Well, let's do this. I'm going to pop the link back in chat one more time, and I'll show you the screen again so you can see it. What we'll do is we'll wrap up with Phil, but definitely visit it's paidforlife.com/PT. You can register for the training. It's a virtual workshop, 100% at home. This one is a Friday to Sunday. He'll have more in the future, but just get in there. It's such a good deal. You've got bonuses, training, and live coaches. This is normally $4,000 to attend. When he did it live, and now you've got the benefit of simplicity, which is at home. You walk out, and like Phil said, you're going to walk away with the know-how and the knowledge to build a portfolio and actually be an active investor. And most importantly, have the knowledge so you're not a dependent on other people. And you're really going to learn, as Phil had described, stuff that they don't teach you. You know, professional investors don't know these strategies and techniques that they share there. They're just, and you've met Phil, you just can tell he's just a good man who does good stuff. His people love him, his followers love him, and you saw it in here. And John just said something as an active investor. Since 1964, always happy to learn new techniques. So I'll pop in that link in chat for all of you. That is paidforlife.com/PT. So Phil, anything else that you want to add, sir?
I just want to thank you guys who are all jumping into the class, and just want to remind everybody, Mike, and remind them again when you send this out, these classes fill up extremely fast, right? It only takes like a day or two and they're all full. So be sure you don't hang out too long here before you jump in. There's still spots available in the classes that are open. And second, be sure you get a good rest before you come. It is a real workout. You're going to be thinking hard. You're going to be in the deep end of the pool, struggling for the first day or so. We know we're going to do that to you. And I just want you to trust that 75% of the people who come through this course are novice investors. They've never invested in their life, where about 25% of them are financial advisors, Harvard Business School grads, and people who are running hedge funds. So we are putting you into the deep end of the pool. And I promise you, if you'll trust us, we'll get you out the other end where you're one of the best investors in the world.
Outstanding. Well, this is really, really, I can't thank you enough, Phil. Always a pleasure to spend time with you. And well, let's not be strangers in the course of these things here.
Well, see you when I travel to San Diego, but boy, we've really cut back on that lately. So Mike, until next time, we can do it virtually. Always a pleasure. I really appreciate what you're doing with your whole crew out there. And it's fabulous. Thanks for the opportunity.
Yeah, it's my pleasure. Thank you. Appreciate you very much. And with that, I'll let everyone go. And thanks again for watching. Phil, talk to you soon, my friend.
Bye, Mike.
Yep. Bye-bye.